General Mills is on the docket today for stock review, and for any of my non-American friends out there, General Mills is a packaged food company. They have tons of different brands. They're all over the grocery store in the United States and even in some grocery stores around the world. And a lot of food companies have been struggling a lot recently, so I thought it'd be great to take a look at General Mills in particular and see if today is a good buying opportunity. So with that, let's get the housekeeping out of the way. The ticker symbol is GIS for General Mills, and it currently has a market cap of about $27.5 billion. And so I thought it'd be most important just to give a brief overview of several of the brands that General Mills owned, because even I was surprised by a few of these, but General Mills is most widely known, I believe, for its cereals. So we have like kind of Cheerios shown here, as well as for its Pillsbury ownership. So the Doughboy, which makes cookies, cinnamon rolls, things like that. But they also own tons of snack brands like Chex Mix, Fruit by the Foot, Betty Crocker, Mott's, etc., etc. So as I scroll down, we can see Pillsbury, one of their biggest brands here, cookies, croissants, cinnamon rolls, all sorts of things like that. Then we have Totino's, known for its pizza. So we get the flat, pizza that anybody that grew up in the 90s or 2000s and went to school, that really nasty cardboard stuff. That's Totino's. They also make pizza rolls. And then we scroll down, we see some of their core Cheerios brands, Cinnamon Toast Crunch and Nature Valley Granola, Lucky Charms. I mean, these are names that everybody recognizes. Moving down to more of their savory brands like Progresso Soup, Old El Paso. And then, again, moving on to snacks like Gushers and Annie's Fruit Snacks. And one brand that I think people are less aware of General Mills owning, because it is a fairly new acquisition for the company, only a few years old at this point, is Blue Buffalo, the pet food company, as well as a couple of smaller brands such as Edgar and Cooper, and then Tiki Cat. So there's really a ton of different brands here that General Mills is involved with, and the company is, like I said, quite literally in any corner of the grocery store, and just about everything people buy day to day has a General Mills brand involved. And really quickly, before I move further, I almost forgot to highlight Haagen-Dazs as another brand that is owned by General Mills. That is one of their more important growth brands moving forward, so figured I should make sure to mention that instead of skip over it. And so, like many different food brand companies, General Mills is struggling to react to tariffs. These companies generally have pretty small margins, and so when their input prices for different foods goes up dramatically, it can make the pressure on profit increase dramatically. And so as we can see down below, the company expects flat to negative organic sales growth and a drop in adjusted operating profits for the upcoming fiscal year, largely as a result of the impact of tariffs and even a little bit of the recent inflation bout that occurred a couple years ago. Now, General Mills is struggling enough that it is trying to spin off and sell different parts of its business that it does not view as being core to its business. So actually just today, the time I'm recording this video, General Mills completed its sale of its yogurt business to Lactalis, which is a French company. So the brands owned by General Mills that have been sold to Lactalis include Yoplait, Go-Gurt, Oui, Mountain High, and Ratio. Again, a lot of these are very recognizable brand names that were owned up until today by General Mills. And of course, these brands were sold to, one, focus on more core and growth elements of the company, as well as two, raise cash, because as we'll see, the company is struggling on its bottom line currently due to, again, the tariffs and input cost inflation. So with that little introduction out of the way, before we move into the numbers, I just want to ask you kindly smash that like button, subscribe to my channel if you like videos like this, and leave a comment down below if you enjoyed this. I'm also open to any positive or negative feedback, and if you want to have a stock analyzed, feel free to let me know, and I will try to fit it into the rotation. So with that, let's get into the numbers. So as always, we're starting with the top line income statement, and as we can see, there has been very little growth over the last 5 years for General Mills in revenues, growing at about 2% per year, and there has been negative growth in both EBITDA and free cash flow, with the free cash flow growth looking exceptionally weak at 13% declines over the last 5 years. Gross margins are fairly healthy at about 34.5%. Operating margins are at 17%, and free cash flow margins sit at 6.4%, which is a noticeable drop off from 2020 when those free cash flow numbers were at about a 12% margin. So there's lots of room for improvement with this company. It's just a matter of focusing on core products and getting input costs under control. General Mills' total assets do outweigh their total liabilities, but in the short term, there is a bit of a flip there, with the quick ratio only being 0.43, meaning the company's current assets minus its current inventory, when compared to its total current liabilities, is about half the size of the liabilities. The current ratio then takes into account that inventory, and even so, if you include inventories in the calculation, the company's current assets are only about 2/3 the size of their current liabilities. So definitely some short-term liquidity issues, and that's why we see General Mills selling pieces of its company. But even with those liquidity issues, General Mills is able to meet its interest payments with current EBITDA interest coverage of about 7.5 and free cash flow interest coverage of about 2.38. So the company can continue to pay its bills, although we can see a dramatic weakening from about 5.2 times coverage in 2020 for free cash flow to sitting now at 2.38 times. So a noticeable deterioration. During this deterioration, though, the company has made sure to buy back shares, and it has been buying back company shares at about 2.6% of outstanding shares per year. So it does certainly help over the long term, especially if General Mills is able to return to previous levels of profitability. Dividend growth has been somewhat strong at about 4.4% per year over the last 5 years, although it's important to note that dividend coverage now sits at 0.93, meaning the company pays out more in dividends each year than it receives in free cash flow, at least for the current year. So if we include the fact that dividends are taking up more than free cash flow, as well as the fact that free cash flow coverage for interest payments has deteriorated, we're starting to see that General Mills does have a significantly weakening balance sheet at this time. And that weakness does show up in how the company is being valued on the open market. As we're about to see, there's a ton of discounts to long-term averages. Currently, General Mills trades at a price to sales of 1.44, which is easily the lowest it has been in the last 5 years. As we can see previous to this, the lowest it's gotten is about 1.7, maybe 1.6 at the absolute lowest in 2020. So the company does have a solid discount of about 28% to its long-term average price to sales. You'll have to excuse me on this. I don't know why this graph refuses to scale properly, but long-term price to earnings average is 15.6 times its earnings, with General Mills currently trading at a value of 12.3 times earnings, which represents a 21% discount to the long term, which has really only been reached one other time prior, back in 2021. Price to EBITDA, again, showing a 27% discount to long-term averages. But price to free cash flow starts to tell a different story. As we saw, free cash flow is the part of the income statement that is struggling most. And so if we judge General Mills on its free cash flow versus its price, we can see it still trades at a discount, but that discount's only 5%. So pretty much a fair value to its long-term average price to free cash flow of 23.76 times. Using this ratio, we can see that previous times, like back in 2020 and 2021, were much better moments to purchase General Mills on a free cash flow basis than today. The company's price to book is currently about 3 times, which represents a 24% discount to long-term average, and again is at a relative extreme based on the last 5 years, only coming close to this one other time in 2021 and briefly in 2020 during the COVID pandemic. Enterprise value to EBITDA again shows a solid discount of 21.25%. And again, we see that when we take free cash flow into perspective, the company is actually trading at a slight premium to its long-term average, with that average being 28.07 and its current EV to free cash flow of 28.56. So we're basically sitting at a long-term fair value. GIS also currently yields 4.75% on its dividend, which is incredibly high. It has only briefly been above 4% one other time in 2020. So to be at nearly 5% today is pretty significant and sits 40% higher than its long-term average dividend yield of 3.38%. Now, if we take a look at the 10-year drawdown chart for General Mills, we can see it's currently in a drawdown of about 45% from its all-time high. That all-time high was reached most recently in May of 2023, and it's been mostly straight down since then. An interesting thing to note is that the lowest this company has ever drawn down was in 2018 at nearly 50% down. So if history is any indicator, General Mills is probably near a bottom, although of course, things can be different. There's nothing stopping this company from drawing down 50, 60, 70, 80% if it continues to struggle to execute financially. Taking a look at earnings estimates, we can see that the light blue line representing 6 months ago estimates is on top, and we progressively go lower and lower as the lines get darker. So 3 months ago, even lower, and then today, the dark blue line even lower. So this represents the analysts getting more and more bearish on General Mills over time, which I think is quite fair. The other thing to note is that the current fiscal year estimate is $4.21, with 2026's fiscal estimates at $3.66. So a significant fall in earnings estimates before experts believe that it will start to slowly grow back out of its issues. So using those estimates, the implied forward 2025 earnings for General Mills is 12, which is really solid and well below its long-term average of, again, 15.6. But it's important to note that because we have dips in earnings in 2026, that forward PE for 2026 prices becomes 13.8. Again, below average, but significantly less below average than the 2025 numbers. So finally, moving on to the X factors, this looks very ugly, and it's mostly a result of the expected growth. So analysts believe that General Mills is going to grow, or should I say contract, by negative 2.07% per year for the next 5 years. Now, from what I can tell, that contraction is entirely in that 2026 fall, and many analysts believe that after 2026's drop in earnings, 2027, 2028, and into the future should show that more standard, slow, let's call it 3 to 5% earnings growth over time. So this negative 2% is quite skewed by the really ugly expectation for 2026, but we're not going to ignore it because that is something that the company is going through. This leads to a PEGI ratio of 4.93 and an FG ratio of 13.23. So if we look at price to earnings or enterprise value and free cash flow, in both cases, the total return of the company looks really, really bad because of that negative growth. And so moving on to the final review of the company, I give General Mills a safety score of 2. The reason it gets 2 is because it is a very, very well-known brand. There's so much recognition in all of its different brand names that General Mills will continue to be purchased by consumers for a very long period of time. And we all need to eat. It's kind of a requirement for us. So General Mills will always have customers. The problem is the balance sheet is really struggling right now, and the company may have to continue to sell off assets in order to improve that balance sheet. And so that's where I see potential medium-term issues and potential serious loss of investor value. Now, as far as quality is concerned, again, I gave it a 2. I think that the name brands are almost impossible to rebuild on their own. I think that the brands themselves are worth more than the market cap of General Mills. But again, the balance sheet is rough. The free cash flow numbers, the bottom line is pretty brutal. And a lot of the stuff causing those issues like tariffs and inflation are outside of General Mills' control. So I think in the long term, its quality is probably closer to a 3. I mean, this is a very solid, well-established company. But I'm also not sure that there's any end in sight in the short term for the problems plaguing General Mills. Now, as far as value is concerned, it's hard to argue that it should get anything other than the max 4 out of 4 score. Everything that we saw today, with the exception of free cash flow based valuations, showed that the company was at a 5-year low in valuations. It has never been a better deal in the last 5 years than it is today. Even if we looked at free cash flow numbers, it's still considered a fair price. So I think General Mills, from purely a value perspective, represents the best deal this company has traded at in a fairly long time. And then, of course, the X factors gets a 0. It deserves a 0. The company is expected to contract, and that, of course, makes your total returns numbers like the PEGI and FG ratio look really, really ugly. So 0 out of 3 for the X factor scores, leading to a total score of 8 out of 15. So a very average score. There's nothing impressive here, and quite frankly, if the stock wasn't trading at such a great value, it would be significantly worse. So for me personally, I'm keeping a close eye on General Mills because I do think this is a company that can last for a very long period of time. And if the market wants to get even more bearish on this brand, I would be happy to scoop it up at lower share prices. But for right now, the trend is quite bearish for a lot of its financials, for its balance sheet, and in market price action. And so I am personally just going to allow it to continue to stay bearish. And then once the company starts turning around, if the stock price takes a little bit of extra time to do so, that might be a good time to invest. But of course, that is all my opinion. None of this is financial advice. Please remember to do your own due diligence. And with that, I hope you guys have a wonderful day. Bye.